Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, we're all in on tech. Older tech, new tech. We're going to talk about OpenAI's possible valuation. We're going to get to that in just a moment. We got to talk about that Apple, Matt.
Yeah, no, absolutely. I mean, look, it's a $3 trillion company.
I kind of hesitated because it's like old, new, like it's all kind of crisscrossing.
Apple is definitely high tech still.
Definitely
it's not the printing press.
But is it old tech or is it new tech?
No, I think Apple is, as much as we sort of joke about or talk about the fact that they don't seem to be on the forefront of AI, they still are doing things that amaze us and change our lives for the better, right?
And that everybody uses as a benchmark. We're also focusing on what seems to be an announcement that's expected to come from President Trump around 4:30 p.m. Wall Street time about another big investment by Apple into the U.S. Lots of questions. We knew we needed to kind of get a reality check once more from Bloomberg News managing editor for global consumer tech. We're talking about Mark Gurman. He's out there in L.A. Mark, good to have you back. Apple shares, investors are bidding it up more than 5.5% as we speak. We've talked about these investments that Apple is doing in the United States previously. Some were already, I think, announced. But this isn't about bringing the iPhone supply chain to the U.S., is it?
Here's why the stock is up. Stock is up because investors, I think, this is just a guess, know exactly what's going on here. This is marketing. Tim Cook, the CEO of the world's greatest marketing company, is telling Donald Trump, who wants to tell his base that he's getting the biggest company based in the U.S. to do whatever he wants, that they're going to be doing more in the U.S. The reality is that Apple invests billions per year already in the U.S., right? They make glass through Corning in Kentucky for iPhone screens. They manufacture with a company called Finisar Face ID components, that's for 3D facial recognition scanning. They do some chip production in Arizona. And so Apple is earmarking another $100 billion, we're told, to a total of about $600 billion over the next half decade or so for US-based manufacturing. They're going to put a fancy name on it, right? They're calling it the Apple Manufacturing, something related to Apple Manufacturing, US Manufacturing, American Manufacturing Program, AMP, I believe Apple is going to call it. The reality is, unless they announce that they're building plants in the U.S. to do final assembly, to do mass manufacturing of iPhones and Macs and other products, they're not doing what Trump has been talking about for years. They're not doing what we've been talking about for years. As far as I'm concerned, I don't believe that's happening, but anything short of that, this is more marketing.
Do we know, I mean, $100 billion is a heck of a lot of money, but are they spending that in 1 year? Or are they spending that in 5 years? You know, are they adding that to haven't they already earmarked $500 billion to spend over the next 4?
Yeah, they've already earmarked $500 billion. So they're going to add to that. We don't have the exact details yet because obviously Apple has not put out an announcement yet. Trump and Cook haven't made their joint Oval Office announcement yet. But in all likelihood, this is going to be about further investments in companies in the U.S. doing manufacturing and R&D and development of components that are then flown to China, India, Vietnam, Malaysia, Thailand, to then be mass produced in Asia to be sent all around the world. Now, I want to be very clear. I'm not criticizing Apple's manufacturing strategy. Obviously, Apple's manufacturing strategy of production in India, in China, and elsewhere in that part of the world is the only way that they are able to produce the quantity that they produce today, at the fit and finish they produce today, and the cost that they produce today. There are so many reasons why mass production in the U.S. is just not feasible. But I don't want anyone to be under the belief that a change is going to be happening this afternoon where all of a sudden iPhones and Macs and iPads and watches can be made in the US. If Apple is able to say that and then execute on that, I will be hugely surprised. But my belief, this is going to be a lot of spin and more of the same. And the background here is obviously tariffs. Those smartphone exemptions are running out. To date, Apple has basically said in total across last quarter and the current quarter, about a $2 billion headwind because of tariffs. That's absolutely nothing, right? That's like Tim Cook could sleep 14 hours a night knowing that they're going to get taxed $2 billion a quarter. The problem is that those exemptions are going to start running out, and Apple wants to avoid that. So how do we avoid that? We make a deal. I'll come to the Oval Office as Tim Cook and say, we're going to do more in the US. We're going to make Trump look good. Trump will be happy, maybe give us some exemptions. So we'll see how it all works out, but that's exactly what's going on here.
So transactional. And it's just getting some of the heat off of Tim Cook and Apple.
Textbook definition. Yeah, getting the heat off of Tim Cook and Apple. We'll see if it works, right? Donald Trump can say anything in that Oval Office meeting. Tim Cook can say anything in that Oval Office meeting. We'll see how it goes. This is a tried and true playbook. Tim Cook has done this with Trump so many times, and it's basically worked every time. Apple has never been largely impacted to any material degree by any of Donald Trump's policies or tariffs, either in the first administration or thus far in the second administration.
All right, let's talk about the fun stuff now. The products, right? You mentioned the Apple Watch. Obviously, we're both using iPhones. I was on an iPad this morning. I have a Mac at home. I just tried to buy a ThunderMax ECU for my Harley Davidson, and I found out it only works with Windows. And I thought, people use Windows? How much market share does Apple actually have? Because Carol and I live in this ecosystem.
Yep, Apple homes.
We don't even think of, Android products, but people do use those.
And like them.
Well, the U.S. is basically half and half. It tilts a little bit more to Apple when you're talking about phones. Tablets, Apple is really the market leader. Smartwatches, Apple's the market leader by far. When you're talking about computers, right, in the US, they have pretty good market share, but on a global level, the vast majority, close to 80% of the market is still dominated by Windows. But they have made strides. And, the most important thing with the Mac is people keep buying them. People are holding on to them. People are sticking in the ecosystem. And they're buying more iPhones and iPads because of it. People get exposed to one product. They want to buy other products.
30 seconds. Does Tim Cook hate all of this?
Well, I don't know how Tim Cook feels. I mean, if I were Tim Cook, this is kind of exciting, right? Get to go to the Oval Office, get to have a press conference with the president, regardless of who the president is. I get to usher in all these new products. Apple is dealing with some complexities right now with AI. Not everything is going well. So it's kind of exciting that he gets to kind of put his foot down right now and try to hammer people home that something needs to change. So no more coasting.
I'm guessing he loves his job, and this is just one exciting part of it.
Well, I have to say investors pretty excited too, because as we said, this is a stock that has definitely lagged some of the other Mag 7 and big tech companies. Right now up about just shy of 6% here in the trade.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
I want to talk a little bit about the markets, as Matt was talking about the outperformance in terms of the impact on the overall market. We're talking about Apple, right? Really pushing up the overall trade today.
Yeah, Apple has been a bit of a loser lately, right?
It's definitely
the second worst performer.
I don't know if I'd say loser, but a laggard.
Okay, it's a $3 trillion company,
loser.
And I buy everything they make.
Yeah, they're doing
okay.
okay.
My point is the stock has underperformed 5 of the Mag 7 stocks this year to date, and 5 of the Mag 7 stocks over the past 5 years. So it's not doing as badly as, say, Tesla this year, or Amazon over the last 5 years.
Right.
But it needs a push, right? And right now it's getting a push from this announcement. But what the market really wants is some AI news out of Apple. What are they going to do to solve the AI problem? We know they'll do something.
It's kind of interesting, though. But again, maybe the read is that if they're doing this deal, maybe the White House will back off of Apple and, I don't know, maybe be a little more sensitive to its needs.
And whenever I say something about their lack of leadership in AI, you're like, don't worry about it. Because we know you're going to buy the next iPhone, and whatever they do, they could buy any AI company.
We bought new phones ahead of the tariffs because, So anyway, let's get to Jillian Wolfe. She is Bloomberg Intelligence Global Equity Strategist. She's here in studio, in our Bloomberg Interactive Broker studio. Sorry for our rant and rave.
That's fine. I love a good rant and rave.
So wait, you sit down there with GMA, or what do you?
I sit right next to GMA.
Nice.
So all day it's just me and GMA going off.
The equities power hub of Bloomberg.
I think we drive everybody else crazy, probably.
No, I read your note every morning before we do our editorial meeting for the show. So thank you very much.
We appreciate
for your
that.
guidance.
Thank you.
So talk to us about Apple and how much that is impacting the trade today.
So I think one of the broader things we're worried about just in the tech space in the U.S. that we've noted is that the premium for U.S. tech in particular over international tech is really at an all-time high. It's not to say that U.S. tech maybe doesn't warrant some premium, because it probably does, but does it warrant this much of a premium is a big question. And one of the things we've found that's a bit of a driver of this U.S. premium over the last decade is they've really been able to expand their operating margins faster, U.S. tech over international tech. And one of the things we're starting to maybe see come up is that if you're going to have this reshoring from companies like Apple, what is that going to do to this operating margin edge that these companies used to have? If that was really driving the premium up so much, does it put that premium at risk if their costs are going to go up if they do invest more in the U.S.? So there's this immediate good news of, yes, maybe there'll be some deal with Trump and Trump's going to help them out. But in the longer run, there's this broader concern of, can these U.S. companies maintain their edge if their costs start to go up?
But they're not really going to invest in the U.S. I mean,
exactly.
We say what we all know. This is just paying lip service to Donald Trump, telling him what he wants to hear, stroking his ego.
Yes.
And of course, when he's out of office, they're going to focus back on Chinese factories, Indian factories, getting us cheaper stuff, because that's what we want more than anything is cheap goods in this country, right?
I mean, it's what makes sense most for their business model. But even Tim Cook said on the latest 2Q call, he really emphasized how much uncertainty there is. He specifically said not to take their September Q3 guidance numbers and use that to extrapolate much further forward, because they don't know what's going to happen with tariffs, because they don't know what's going to happen with prices. So it's definitely a concern that's hanging over the market. I mean, I think one of the bigger pieces of news, you were just mentioning AI, was what happened a month ago with the AWS deal in Korea. Right, they're building this massive AI data center out of Korea, not in the U.S., and that's allowed the Korean stock market to be the best performing market by far over the last 3 months. I mean, they're up over 25% because one of their largest companies, SK Group, is going to be in charge of building that. So now you're starting to see U.S. companies, if anything, further invest in key areas like AI in emerging Asia.
But that's what, Jillian, companies do, right?
Exactly.
I mean, they tend to also like to do build outs in the markets that they sell in. It's not always the case. And there's some goods that just make sense to make in certain places because it's just that much cheaper. But you do increasingly kind of see companies doing that, right?
Exactly.
So is it really that much more ramped up? Or I don't know. Like, I'm not quite sure what the read is on that.
It's difficult to say because you're getting a lot of conflicting information, right? You're getting that you might have this $100 billion investment from Apple in the US. You have this AWS build out in Korea. Ultimately, companies are going to keep looking for cheap ways to build their product. Right.
That's just smart business,
right? It is. And the U.S. market has broadly, we talk a lot on our team about how the economy is not the stock market, right? So while improved U.S. manufacturing obviously helps for the U.S. economy.
Were you thinking no?
I hate it when people, this has become a mantra. Carol said it. I heard somebody on Romaine's show say it. Now you say it. No one ever said the economy is the stock market or the stock market was the economy. The stock market is a discounting mechanism that looks at the future of the economy, maybe. But sorry.
Well, but it's been difficult because you've seen the market hit these new highs. Manufacturing data is poor. Consumer sentiment data is poor. So what's happening? And the answer is, particularly in the U.S., maybe more so than even in other markets, you're seeing the equity market really unmoor itself from manufacturing results. The stocks in the U.S. don't really rely on manufacturing activity in the U.S.
We're not really a manufacturing economy.
Well, let me tell you something. I have a 4-year-old daughter and a 1-year-old daughter.
You do.
And I'm not hoping that they end up building iPhones at a factory in like Elizabeth, New Jersey. Like, that's not the future that I'm planning for those
Again,
kids.
with the New Jersey.
I said Elizabeth.
I know. But anyway.
I'm a lifelong New Yorker.
Jillian, this market going to rotate, or are investors going to finally rotate out of this mega cap concentration? Because we were talking to Bill Smead the other day, and he said it reminds him of 1987. We have 10 stocks making all the profits and getting all the gains. Like, when does that change?
It's very concentrated right now, but what we're seeing, we break down the earnings growth of the Mag 7 versus the ex-Mag 7 on our team. We look at that a lot. The Mag 7 being those magnificent 7 stocks in the S&P 500. And right now, what we're still seeing and what analysts are still projecting on the street is that the Mag 7 are going to grow earnings in aggregate faster than everyone else. But that's expected to slowly converge as we move into 2026. So we see that as a potential driver out of that maybe Mag 7 or nothing trade, but we're still seeing it take place. The Mag 7 have been growing earnings faster, are projected to keep growing earnings a bit faster for the next few quarters. We're really going to need to see the rotation pick up. But I think it's something that investors are keeping an eye on, particularly as tech just becomes so expensive in the US as well. I mean, at what point are the strong fundamentals going to justify these multiples?
But beyond the Mag 7, you are saying you're seeing earnings growth in other sectors, right? So
yes,
that is the opportunity for catch up, right?
There is. And the gap between the earnings growth of the Mag 7 and the other sectors is narrowing. I mean, in 2024, it was huge because the Mag 7 had this big AI bump.
Right.
I mean, we had a little bit of this, there is no alternative to the Mag 7 because they just looked so much better. It's not to say that everything else looked bad. It just looked significantly less good.
Right now they're 26% and the rest is 4%, whereas they previously were like 68% and the rest was 2%.
Yeah, I mean, there was a period of time where the rest was negative, honestly, and all the growth was coming from the Mag 7. So we have at least got a return to growth outside of the Mag 7.
I know this because I read her research all the time.
I can tell.
I love it. I feel like I know what you're talking about.
To date.
Oh,
thank you.
Come back anytime. Jillian Wolf, Global Equity Strategist at Bloomberg Intelligence.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
From a tech company that we don't, but probably should be talking a lot more about, to an iconic corporate brand company and stock. It's a company that continues to kind of mesh its long-standing businesses with new ones and kind of evolve along the way. We're talking about Walt Disney. Stock is down about 2% in the trade. It was down as much as 5.2% earlier on. Let's get to what you need to know about their earnings and also some of the news that we got early this morning. Geeta Ranganathan is with us. She's Bloomberg Intelligence Senior Media Analyst, again out there in Princeton, New Jersey at BI headquarters. All right, Geeta, I think initially Disney was up in the pre-market on some of that ESPN news, and then earnings came out, and then it kind of shifted in another direction. Walk us through all of the news flow this morning.
Yeah, plenty of news for this morning, Carol. I actually thought that the earnings was extremely strong. I mean, if you were looking for a beat and raise, you got it. I think why we saw a little bit of that pullback in the shares after they reported was because maybe the guidance raise was not as much as people had hoped for. So they did take their EPS for the full year up to 18% growth from last year, and that compares to 16% is what they had projected earlier. I think maybe the street, the buy side, was looking for something closer to 20% or over that. But really, I mean, the big news, of course, and you spoke about this, the pre-market was, the NFL taking a 10% equity stake in ESPN getting control of some of those NFL media assets, including NFL Network and Red Zone. And why this is important, Carol, at this point of time is because ESPN is actually going a la carte. For the very first time, in its history, they're going to offer all of the ESPN TV content on a streaming platform. That's going live in a few weeks, August 21st.
It's a big deal.
And so it makes me so happy.
It's a huge deal.
Yeah.
Wait,
I mean, the reason, Geeta, that makes me happy, and probably everyone else who pays $80 a month for a cable subscription that he doesn't use, is I can now cut that cord completely because all I want from it is NFL football, and I can just buy that from ESPN Plus.
Yeah, and you're going to get even more of it, Matt. So they're basically really kind of buffering up their whole lineup. Now they get additional games with the NFL Network. You're going to have Red Zone, which is, again, a huge property on Sunday afternoons. So this really kind of helps them, first of all, gives them much more content. If you're big into fantasy football, again, they're merging the NFL fantasy football with the ESPN fantasy football offering. So, there's just a lot in terms of the offering itself. And then if you look at it more from a long-term perspective, perspective, Carol and Matt, I mean, just kind of having the NFL as an investor in ESPN, I think just speaks to a much more sounder future. It kind of really is future-proofing the business for Disney and for ESPN.
Why? Can you explain that? Is it just because you're going to have that NFL franchise and you own it, basically? Or got a good friend in it?
That's a huge part of it. So NFL, of course, is the premier sports property when it comes to, TV viewing in America. So you're looking at the top 100 broadcasts every year. 80 of those or 85 of those are actually NFL football games. So again, huge. The other thing is that NFL has media deals right now with Disney, with CBS, with Fox, but they do have this opt-out clause. So they can get out of those deals in another 3 to 4 years. And what we think this does, this whole ESPN, NFL, kind of equity stake and exchange of assets, is I think it really kind of secures ESPN's future. So I don't think, the NFL would ever want to opt out now with ESPN as their partner. Yeah, go ahead.
Sorry, Geetha. I always look at a stock performance over a 5-year. That's my default. Mainly because it's the terminal default when I do the comp function, but also because I think it's a fair window by which to judge pretty much every stock. Now, I'll go for Disney. I'll just go 3 years because I don't think it's fair to include the pandemic. We were locked down. We couldn't go to the Magic Kingdom. But over 3 years, it's still only up 10%. And I hear from Paul Sweeney every morning that the parks business, he probably hears it from you, that the parks business is on fire. So why isn't this company doing better?
Parks is on fire, Matt. They reported 22% growth, profit growth at their domestic parks, and they have just so much more coming on board over the next year or so. So yeah, it has been kind of a roller coaster, right? Up and down with the Disney stock price. I think the really two things I think that investors are looking now in the Disney narrative is theme parks, and you just brought that up, and we're going to continue to see pretty good momentum, both domestically, internationally, cruises, all of that. You got everything going there, and then streaming, right? So streaming is kind of the big thing. Right. We've seen some good profit, but we need more.
Geetha, thank you. Disney is a company we just love talking about with Geetha. Geetha Ranganathan of our BI team. Shares of Disney down about 2%. That's coming in on Bloomberg Businessweek Daily.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Hey, a few stories with some news in the real estate space. You've got Apollo Global agreeing to acquire a majority stake in Stream Data Centers, making its first such acquisition in the alt asset manager as it really looks to diversify, I should say.
This is, I think, fascinating. Data center investments, I have so many questions.
I do too. Yeah. There's a lot of money going into it. A lot of money.
But how fat are margins going to be in that business? I mean, if power prices go up, who eats that? And I just don't know.
I don't know.
There are examples of companies that have done really well. Digital Bridge has really boosted its top line and has now started to turn a profit. And they do a lot of that business. So.
Everybody talks about that. We're just going to need more and more power. But you're right. I don't know. It's a good question. Our next guest, though, really focuses on distressed real estate. We kind of want to get into that, especially when it comes to mid-size multifamily sector housing. So let's get into it. Back with us is Amy Rubenstein. She's CEO of Clear Investment Group, and she comes to us from our Chicago News Bureau. Amy, good time to have you here. Last time we talked was December. There's a few things that have happened, like a new president coming in and lots of changes from the White House. Talk to us a little bit about how your market has changed. What's going on?
Yeah, we started off the year really strong. We started to see transactions pick up. And then tariffs got announced in April, and it started to slow things down again. I think people sort of took a little bit of a backseat, trying to wait and see what was going to happen. And now I think we're starting to see things normalize a little bit again. The fundamentals of affordable housing or low-income housing, workforce housing are all still really strong. Unemployment is still really low.
There is affordable housing? Where?
Well, so yes, that brings us to a great point, is we do have a massive shortage of affordable housing, which makes that market and that sector really strong.
You know, Amy, when I talk to people in the real estate world, I always get questions sent over from the reporters more knowledgeable on this space than me. And they always, lately, they always want me to ask, does this person have enough cash saved up to go in and make the purchases? Because now is when you want to be in your industry, in distressed real estate investing. Is that true in multifamily as well? Is that true in residential as well?
Well, so the multifamily that we're dealing with, if you're talking about individuals buying housing, we are dealing with renters by necessity and not lifestyle renters that are choosing between choosing a house to purchase or an apartment to live in. And so we're never competing against that particular market. But right now, the question is for people buying multifamily is, can you get the loans? And that's, comes back to where interest rates are at right now, how banks are doing right now, and we are seeing it to be an easier market to get loans in today than we were at 12 months ago or even 6 months ago.
Well, so let's talk to you about where are the opportunities right now. Talk to us about maybe a recent deal you have done, and give us just geography, the particulars. We're always interested in that and kind of what is getting done as you work within your space.
Sure. So the last deal we bought was about 700 units in Washington, D.C. It was bought out of bankruptcy court. So there was a lot of distress in the deal in the sense that there just was not a focal point of leadership at that property for a while. Tenants were upset. The city was upset. It needed a clear focus and a path forward to get to stabilization. So we bought that deal and have since then started to stabilize, mostly stabilizing through communication with tenants, communication with the city, and really trying to then dig into where the deferred maintenance that needs to be fixed and taken care of, and how do we get to that stabilization, which is pretty straightforward when you have a property that has that type of distress on it.
You're at a shop with a great reputation, a Clear Investment Group. You have raised a ton of money, right? I think you just raised another $300 million fund, and you seem like you seem like a super nice person. So how do you avoid being a slumlord? Right? At these levels, what do you do to make sure you'll make money and have a clear conscience?
Oh, absolutely. So our model is fully aligned with our tenants and fully aligned with the other stakeholders of the property, the city, the municipality. We often are buying from slumlords, not always, but often when we do see that type of stereotype, that's the kind of property that we're actually buying. So then we're stabilizing it to get to a place where we're providing safe, habitable housing for our tenants. And so that is our business model, which aligns with what those tenants are looking for. And so we're the opposite of a slumlord. We're actually trying to fix something that would cause a property to be classified in that way.
Why does that happen? And I ask that kind of naively because I want to. Because is it just bad people? Is it just because the business dynamics don't really work? You guys are on a mission to make quality housing available to the working class. Like, is it just it doesn't work on a business level, or what? What goes wrong?
So what goes wrong is it can happen, a few things that happen, but usually what it comes down to is the seller actually being distressed. So the current owner of the property has some sort of distress in their lives, whether that's a financial distress in some other business that they have, or a financial distress that's coming from some other form. It's usually not coming from the property itself, but some things could push it over the edge, like interest rates, like COVID. Those are the types of things that could push an owner over the edge. What starts to happen is communication starts to break down between the tenants and the landlord. The landlord stops putting money into the property, and therefore tenants start to get upset and stop paying rent. Maintenance isn't taken care of because tenants aren't paying their rent, and then more tenants stop paying their rent. And it's a really bad downward spiral that starts to happen. So I don't think it's that anybody goes out trying to achieve distressed property, but it just happens, and it happens quickly. How
are renters doing? Are you seeing stress, though, in their ability to pay rent?
I think that the fundamentals right now are really strong. So for a while, we were seeing expenses rise at a very rapid pace on apartment buildings, and then also for individuals in their homes, right? Inflation was really high for a while. It has started to come down. Employment is really strong right now, so people have jobs. So where I do think it was a struggle for a little while, there was a period of time where we did see people struggling more, and I see that starting to settle and starting to stabilize now.
Amy, I want to get your take as not as an investor necessarily in this market, but just as someone who sees what's going on and understands the industry better than anybody. New York City is like unaffordable for most people, right? $4,000 is what you need to get into a one-bedroom in Manhattan. Right. We have self-proclaimed socialist mayoral candidate who's doing very well. He wants to put on rent caps. What do you think about this situation? How would you assess it?
I strongly disagree with it. I think it's really, really bad for the housing market. Because what happens is now landlords are in a situation where they can't raise their income as much as their expenses are rising, and no one's capping their expenses. So when you get a rent control situation like that, what happens is the landlord usually will start to spend less in the property, especially when they weren't prepared for it in the onset. If you go and you buy a property that was not rent control, and now all of a sudden rent control is placed on it, your model was just thrown off. So you might not be able to have that sustainability or that wherewithal. And that's where you see landlords get into a lot of trouble. And what happens is that ends up negatively affecting the tenants themselves. So they're the ones that end up losing.
You always open up a window into certainly this part of the housing market. So really appreciate it. Amy Rubenstein, she is CEO of Clear Investment Group, joining us from our news bureau in Chicago. When we come back, a check on trading and some of the stocks on the move. Carol Master, Matt Miller, and this is Bloomberg Businessweek Daily.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.